Dear students, as we have discussed in the previous classes, one important theme of macroeconomics is the explanation of what determines an economy's aggregate output of goods and services. At any time, that output may be equal to what can be produced with the full utilization of resources, or it may be less than that. That means at any time economy will be producing a level of output consistent with the full employment or less than that. What actually is the output of goods and services can be determined only by measurement, only by calculating the total of goods and services produced. And the question of measurement comes under the heading National Income Accounting. The question of measurement comes under the heading National Income Accounting. So in this class and also in the succeeding classes, we will explain national income accounting and various issues, conceptual issues associated with the national income accounting. There are two approaches to national income accounting. One is the expenditure approach. The expenditure approach. The other one is the income approach. There are two approaches to national income accounting. One is the expenditure approach. The other one is the income approach. Whether you use expenditure approach or income approach, you will get the total. The total is known as gross national product or a gross domestic product as a measure of economy's output of goods and services. GNP, GDP. Two related measures of the aggregates are NNP, net national product, and net domestic product. Net domestic product. And the other aggregates used in the calculation of national income is national income as such. And two other aggregates, though not a measure of national income, but can be used as national income under certain assumptions, are personal income and disposable personal income. So these are the aggregates which we will consider. GNP, GDP, NNB, NDP and NI. Then personal income and disposable personal income. So we will use these measures as measures of aggregate supply depending on whether we are considering a two-sector economy, three-sector economy or four-sector economy. And conceptually, the expenditure approach or income approach will give you a figure for the value of final goods and services produced in the country, and conceptually whether you use expenditure approach or if you use income approach, you will get the same figures. You will get the same figures as measure of national income. And if you are using expenditure approach, from the expenditure side, we add together expenditure by consumers, expenditure by consumers, expenditure by business sector, and expenditure by government, and expenditure by rest of the world. We add together expenditure by consumers, expenditure by business sector, expenditure by the government, and also expenditure by the rest of the world. Now, a total obtained by adding together this is the GNP or NNP, and denoted as a measure of aggregate supply denoted as Y, is defined as C plus IR plus G plus X minus M. C plus IR plus G plus X minus M. And I will explain all these concepts in detail when we proceed. Consumption expenditure, expenditure by the business sector, realized investment, government expenditure, and net exports. If you calculate national income from the income side, you will get the amount devoted for consumption, the amount devoted for consumption, the amount of income devoted for the payment of taxes, and also the amount used for savings. And from the income side, if you calculate national income, you will get the identity C plus S plus T. C plus S plus T, consumption, savings, taxes. So whether you calculate national income from the expenditure side or from the income side, you will get a total, and you will get the same total. The value of national income, whether calculated from the expenditure side or from the income side, you will get the same total. In the 1930s, national income accounting provided little more than figures of economy's aggregate income. That means in the 1930s, national income accounting was in a very rudimentary form. Only some aggregate figures were available as national income total. It was the publication of general theory in 1936 that led to the development of national income accounting from its rudimentary form. General theory not only hastened the development of national income accounting, it also influenced the form, the way in which national income accounting is constructed. That is, the framework in which accounts are presented, national income accounts are presented, are designed to facilitate the study of macroeconomic problems with the Keynesian tools. So, the way in which we present national income accounting is consistent with the study of macroeconomic problems using Keynesian tools. That is a point which we will discuss when we study Keynesian theory. Actually, there are two pioneers in the development of national income accounting. They are Simon Kuznets and Richard Stone. These two economists are the pioneers in developing national income accounting, and they received Nobel Prize in economics for their contribution to the development of national income accounting. And their study is presented in the book National Income and its Composition. National Income and its Composition, 1938. National Income and its Composition, 1938. Now, in the Keynesian theory, aggregate demand is the key factor determining aggregate supply or aggregate output. Aggregate output, national income, aggregate supply is determined by aggregate demand. And aggregate demand consists of spending by consumers, spending by businessmen, spending by government, and spending by foreign sector. As we will see later, aggregate demand is equal to C plus I plus G plus X minus M in a four-sector economy. That is, aggregate demand consists of spending by consumers, business, government, and the foreign sector. It's different from the notation here. IR is different, and I will explain why I is different from IR. So these two measures are measures of supply, C plus IR plus G plus X minus M, C plus S plus T. And we write Y in terms of its components, that is all. But this is a measure of aggregate demand. So this is desired consumption expenditure, desired investment, desired amount of government purchases, and desired amount of net exports. So, in the Keynesian theory, aggregate demand is the factor determining aggregate supply, and aggregate demand consists of desired spending by consumers, business firms, government, and rest of the world. So, consequently, classification of aggregate output into these parts obtained by each of these four groups is the core of accounting framework. It is the core of accounting framework. That is, national income obtained by these four components is the core of national income accounting framework. And remember this, national income accounting is presented in such a way as to facilitate macroeconomic problems using Keynesian tools. And we will consider the connection between national income accounting and its connection with the Keynesian theoretical framework. That also remember this, national income accounting developed only after the publication of general theory and in 1936. And the two pioneers in this respect are Simon Kuznets and Richard Stone. They received Nobel Prize for their contribution in this field also.